Okay, OJ on. Nice. Down there, okay. Thanks to the diligent listeners in chat. I was testing the audio. Appreciate that very much. We got a much better setup here now. Edward, programmer hands. All right, let's go.
There are two things about Chicago finance you can't get anywhere else.
Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. It is Wednesday. We have an hour into the bell. Equities are looking okay. Bitcoin, not so much. They're trying to buy a lot of stuff today. Silver, too, is making a little bit of a comeback. I had been a little worried about the metals. Those charts were looking pretty dicey, but perhaps silver might still have one more trick left up its sleeve as we are getting some solid movement. Silver right now up to 77 bucks in futures, a 4% rally. The other thing I think that's important is that the SMH is looking good. Semiconductors, I mean, I don't know, up 1%. Kind of looks like they want a fresh breakout, possibly. Here's the chart for semiconductors. My number one trade right now is long semis, short whatever else you want. I think that's the way you navigate the fat trimming that's happening across cloud, across software, and of course in Bitcoin. BTC down below 67.5, down almost 2.5% on a day where folks are taking a stab at risk assets. It's not a huge day, but the spread is notable, which is the spread between the NASDAQ up 0.5%, the S&P up 0.33%, and Bitcoin down 2.5%. And it's not for lack of trying. My goodness, the pumpers in chief were out in style and storm over the last 24 hours, with the president's sons appearing at the same time on CNBC saying they've never been more bullish in their life. Here's a quick little TV tip for you. If you ever see two people on set as guests at the same time, it's a promotion. So, at this point, who's left to buy is the question. Because the problem is that Michael Saylor has announced that he will be buying price insensitively. I don't want to go too off the reservation just yet, because Mark Dow is going to be joining me later on the show, and he's got some great thoughts on crypto. But surprisingly also among the pumpers was Scottie Pippen, who apparently sold his X account to pump crypto, drawing pennant patterns on BTC. Here's the irony, as I said last night, nice pennant pattern, Scotty. Now check out the bearish divergence. I don't think he read it, but lo and behold, guess who walked into the Alston last night around 10 p.m.? The one and only Scottie Pippen, looking a solid 6'6", while I was having a refreshing beer. So I gave him the shout, but no Bitcoin was discussed. The irony, truth stranger than fiction, and fun. Like Chicago legendary sighting. Now, as far as the crypto stuff, we'll come back to it because I know Mark Dow is going to have some important thoughts on that matter. The other thing that we've been talking about that is so crucial is generally volatility and the way volatility has been shaped, long dispersion and short correlation. Once again, the VIX is off its highs of the day as options traders have kept volatility fairly suppressed despite everything that's going on. Let's bring in Brent Kochuba joining me from SpotGamma. Brent, what's going on, man?
What's up, Oliver? How you doing, man? Good to see you today.
Likewise, fun market here. There's a lot that's trying to make a move. You know, silver, which I was thinking kind of might be dead in the water, is showing some life again. What stands out to you?
It's an amazing rally with VIX expiration this morning, right? The idea that VIX expiration would loosen things up a little bit turned into be true. I thought that would express itself to the downside, Oliver, at the jump. So full disclosure there, you know, throw your hand up when you're wrong. We rallied up to 6,900. What happened at 6,900 is the call sellers came out and they started to hit the thing pretty aggressively. And then I think we got a little comment from some of the Fed governors about, you know, maybe a little more hawkishness in the Fed minutes than some people expected. So that initial rally faded a little bit. Now we're squarely in this OPEX window, right, where markets can pivot, and that's a statistically backed statement, right? We tend to see reversions here. And so if you had to just look at the stats, you would say, okay, look, the vol's a little bit elevated, VIX around 20. S&P's been kind of pulling back in this OPEX. Semis look strong, as you mentioned. That should be a place for a bounce, but we still have not rectified this whole dispersion situation, right, that we've been wrestling with for a few days. So, you know, it's a very like chippy environment, right? And the way that we navigate this is pretty easy. Over 6,900, I think that positive gain will start to support the market. That's the sign that what we've been going through is the correction. When you get under that 6,900 level, there's a lot of negative gamma down there, all the way down to that 6,600 level. And if this vol starts to move up, you know, that's where things can get really spicy to the downside. So I've been sounding like a broken record with this sort of sub 6,900 area being one to worry about. We've not paid the piper, as your chart shows there. We've been consistently bouncing there at that 6,800 level. So, you know, the thing, if there's anything that just sort of says, hey, something feels funny, it's still this kind of dispersion trade. But maybe your point yesterday, this normalizes a little bit the upside with single stock vol coming in, index vol picking up a little bit, and everything just sort of resyncs, right? And I think that's ultimately what we want to see is a resync.
Brent, I don't mind a broken record when it sounds good. And I think that the levels have definitely held. You know, let that baby spin until something changes. Because that, I mean, I got it right here. The yellow line at 69. It's almost a perfect symmetrical range that we have. We have resistance 100 points above at 7,000. We have support 100 points below at 6,800. That's the record you've been spinning. The lines hold. So I think it makes sense, right? That anything within that range, we can chop. But whenever we do make the move, we should be cooking.
Yeah, and we've not had a good, persistent directional shift. And if you look at the last 6 months, October, November, December, January, all of those have been OPEX pivot points where you see the market has been coming down into OPEX and then bounces out. So, you know, again, statistically, in the way the market's been trading on OPEX, you say, well, it makes sense that we would have a little bit of an extended bounce here. And so, you know, you want to look at that kind of glass half full thing. And you could say, well, mags have been sold off pretty strong here. The software stocks are really beat up, so maybe there's some value hanging around in there. But, you know, yes, semis are up 1%, but what is the story or what's the narrative sort of, again, lead to a chase to the upside? Next week we get, on the 25th, we have Salesforce is going to report, NVIDIA is going to report, Zoom reports. So we're going to get some more of these software names, some of the bigger software names, I think, reporting. NVIDIA, you know, can always be a big catalyst for the market, so maybe that solidifies that story there. But, you know, for right now, we just keep getting this anxious kind of chop, right? And I think it, you know, we need some resolution, right? Either let's get the puke over with, or let's engage the upside. This should be that time frame where one of those two things start to happen.
Okay, now some of the ways we'll be trying to figure that out today on the show, or I want Mark Dow's take on how crypto relates to stocks nowadays. I mean, I think we've all kind of seen it in the charts. Scotty Bauer is going to be on, but I think yesterday we talked the gold and the silver element, which I think also might give us some taste, because there's risk appetite. What I'm trying to figure out, obviously, Brent, as we talked yesterday, and as we're all trying to figure out, is which way we're more likely to break. I feel, and this pertains to something you said yesterday, that the onus is always on bears, especially when you have a general trend, that has been supportive. Maybe it's sideways, like we just talked about in that symmetrical chart, but generally it's been supportive. So the longer bears go lopping off the heads of all these cloud companies and the index doesn't break, I feel like we're more likely to resolve higher. And yesterday you said something that got the chat kind of fired up, because you're talking about 70% of trading coming from zero DTEs, and somebody said, that's the market being held up by lotto tickets. I don't think that's the way to think about it, is it?
Well, I was looking at this study last night, Oliver, and what I found is that the modern market, sort of the post-zero DT era, which is 2023 forward, there's a lot more jump risk now in this market versus the period before. What does that mean? We'll have days of calm, and then suddenly you get a big jump, right?
That's
100%. A new phenomenon. It's a new phenomenon, and the only thing that's arguably really changed is zero DT. Now, correlation is not always causation, but you continue to see these moments, and we watch in our indicators where you see the zero DT supportive flows are there, they're there, and then bam, 1 second they're just not, they're just gone. And it's on a tweet or it's on something else. And so what that means is historically the best, or what you should expect tomorrow in the market is what happened today, right? There's that kind of auto correlation. Correct. And that breaks down a little bit now. And so what's interesting to me about this, we look at this range, it should wear down, right? The vol should calm down, and that should generally put a bid into the market. That's what you'd expect if we hold that level. But if we're being held in by 70% zero DTE options in the S&P, 85+% of the NASDAQ, and that's the persistent flow, that flow is only there as long as risks are pretty normal, right? Anything that pops up, Iran pops up, or worries about interest rates, something that can't be hedged, something you can't hedge with a zero DTE, that's where risk starts to spill over, and you get that jump risk, right? That you get that sudden spasm that we talk about so much, and that's clear in the data that we see this. And so it's important when you're looking at this today, and you say, well, last week we were kick saved by 70% zero DT flow. I don't think you can count on that coming back in to support us on the next dip, right? So that's always the risk we're sitting here. And when you look at that structure all on your screen, you see nothing but red on that chart, right? That red is negative gamma all over. So there's not a supportive flow here in the market. Rates are going to creep up allegedly. We have this dispersion situation, right? So I'm searching for the narrative to feel like this can all sync up and move to an upside, manifest in an upside rally, right? And it's hard to find that thing, right? It's hard to find that narrative. Lastly, just on the vol premium situation, 1 month realized vol in the S&P is at 14. Typically, if you add 3 to 4 vol points to that, you get a fair value for the VIX. Now, kind of like using technical analysis on the VIX, a lot of people are going to throw their shoe at the screen when they hear that, but that's just a barometer, right? So if realized vol is at 14, you go fair value for the VIX is like 18. So can you make an argument that there's some decent vol premium here from that perspective? Maybe a little bit, because that's always a nice flow. But if you look at where the VIX arguably should be, or vol should arguably be in this situation with the dispersion, you would think that the VIX would be closer to 25 or 30, for example, right? So this is the tricky spot. It's like there's definite call selling that's pushing call skew down. Overall, IV rank in the S&P is like an 18, so it's not particularly high right now. So it's not that vol premium is just not that attractive. I think it's attractive in the software stocks we talked about yesterday, but volatility is sort of an asset class. There's not that all much premium right now to say, okay, great, smashing that vol in one of these kind of Vanna rallies can come into play right now, just because I don't think the vol is that rich. It's pretty benign at the moment. So that also matters to the downside, because FIX is at 80. you've already crashed, right? So you can easily say we spill down to 6,600, then you get VIX at 30, 35 or whatever it may be. Then it's worth coming out there to maybe sell some S&P puts because the vol got so rich. And again, we just don't have that situation or that dynamic right now. So it's hard to sort of extract a trade idea or trade view that has a lot of edge at this moment.
Honestly, I like the way that you put that, Brent, frankly, because, sometimes it's just not there. Sometimes the game is less juicy than others. And I think it goes back to the chop of the chart for the S&P 500 from a technical perspective. Those are tough markets. In many cases, those are the hardest markets for people are the chop markets. Mm-hmm. And I hope that's the way we could clean some of this froth out, is by way of sideways chop instead of steep downside. To come full circle back to the chat's point about the zero DTs being lotto tickets and kind of your point about the convexity we're experiencing, my view is that they're not the lotto tickets in terms of the probability, because supportive options flows, you're generally going to be making money on those. The market, if you're generally long, you're generally going to be making money. Like, it's a generally good bet. Now, of course, when you deal with the convexity of the expiration and how quickly that moves, that's when it gets to your point about how these markets can move quickly. But that's kind of why people want them, right? That's kind of the action is the juice.
Yeah. I think that, with so much focus on Captain Condor and some of the retail option selling, there are times where that big retail trade or, the income trader, so to speak, is in control of the market or is putting trades out there that can impact the market, let's just say. Mm-hmm. But I think the dominant flow, when you think about zero DTE flows, it's not people buying a lottery ticket. It's dispersion trades in and of themselves. You trade S&P versus NVIDIA, or maybe Google and Apple and all these other names that now have Monday, Wednesday, Friday expirations, for example. Or you're hedging your book, right? Or it's a market maker, who sold some zero DTs in one part of the one strike zone, and they got to buy, contracts or strikes in another part. So there's a lot of reasons to trade zero DTEs. Not all of them are simply trying to extract some vol premium with daily selling, for example, right? And I think that's an important thing. When you see the market crash, you see zero DT call buyers come in. Why would you do that? Well, if you own a put, let's say a 1 month put, you could hedge it by buying zero DT options. Mm-hmm. If you're short futures, you can buy zero DT calls as a way to hedge that out. If you want to get conspiratorial and say, we really want to jam this market, I'm going to buy 100,000 zero DTE calls, well, you could foist a lot of hedging obligation on somebody, right, in a very short order. So I think a lot of people think of these things maybe as a lotto ticket, or there's negative edge in persistently selling those things. I think that's true. But there's also a lot of great reasons for institutional traders and retail traders alike to express different ideas. And I think that those ideas that get less attention are more dominant in the market, i.e. Captain Condor matters on occasion. He's gone now, but he did matter. But on the day in and day out basis, right, there's some other flow. I mean, you don't get $5 billion in S&P call selling, zero DTE, and spider call selling. That's a big trader out there, right? Hitting this thing. For sure. And today was the same thing. After this Fed news came out, the call selling was rather large in the S&P again, and we did see a little bit of put buying come in. And the problem is when you start to see call selling, it's like, great, well, we sell calls and the market goes down, those calls go to zero. Hedging obligations related to those calls also go to basically zero, right? They're not impactful as the market declines. If people are buying puts, that's a hedging obligation out in time. Right.
That's why our expiry is so important on Friday, right? Because then we see we get a clear look after some of the required flows have to shift over and people make new bets now for the month ahead.
I think that's right, Oliver. And also when you're looking at the tenor of the flow, zero DT or not, right? If it's a zero DT put, okay, that's exposure for today. But if someone's buying March puts, April, May, whatever, that keeps the hedging obligations there, right? They're the persistent hedging obligations to the downside. And I think that's why the amount of zero DT flow matters, because the moves maybe aren't as sticky, maybe a little more mean reversion in those environments. And if you get a situation where longer dated put buying comes in and put skew increases and the VIX keeps its bid, that's all a sign that put buyers are coming in and downside may be stickier. Last thing I would just say,
we're not out of the woods by any means, at least for another 48 hours for sure. We got to try and push some of that back, to your point.
Yeah, exactly. And they're saying that stuff in Iran is building. I have no idea or not, right? But you start to think about, is there a reason for someone to start hedging and owning some legitimate hedges, right? you can't hedge an Iran conflict with zero DT options, right? So, are there some of those signs that some of the stuff's picking up? One of the other things I'll just add here, Oliver, is that if you look at big single stocks, put skews are lifting in those individual stocks, right? And it's very concentrated. There's a lot of bearishness now in the single stock space, but the implied vols aren't all that elevated at the moment. So what does that mean? It means people don't love calls at the moment. They're leaning into puts, but the vol hasn't really paid off yet. And to really say this is a great opportunity for a bottom, you want to see that vol spike, right? Again, it's easier to call a bottom in the market when the VIX is at 80 than when the VIX is at like 20. So you haven't seen
sure.
that.
We're stuck in a no man's land to some extent. Somebody in chat put it as a choppy market is a bad signal to noise ratio, which I thought was really good because the moves become kind of noisy. Brent, to your point about hedging the Iran situation, well, I might have something for you on that front, Brent. It's poly market, baby. Always something there we can find. Brent Kochuba, appreciate it very much. Thank you, sir.
Thanks.
You the man. Great analysis there of the volatility landscape. By the way, me and Brent next week, we are at the Money Show in Las Vegas. It's going to be a fun one. I got Mr.
That's
Jon
right. You're gonna
Najarian.
play. You're gonna play some poker with my partner Matt. Matt's a sniper, man. He's Minnesota ranked.
I'm not messing with Matt for sure.
Yeah.
But hey, if you're at the table at the same time, then you might have a little bit of a brawl. But he's playing six max, Brent. He's a little bit of a high roller above me. He's going to play six max Hold'em, which is totally different from nine, which is a fun game to blast. But I'm a businessman now. I'm not as much of a blaster.
I hear you. He has an established edge too. Me, I got no poker edge. Some would argue I don't have any trading edge either. So I'll stay in my hole.
Well, the analysis has been good here on the range. Appreciate it very much, Brent Kochuba, SpotGamma. Good little setup there for us too to think about hedging geopolitics with the poly market bet. U.S. strikes Iran. I mean, hopefully, Jon Najarian, these numbers stay low. But this is, after all, the future of finance. And if you want a direct hedge, it's kind of the way to do it. What's up, John?
It's all good, Oliver. Thank you. Great to be back with you, sir.
You want to buy any of these way out of the money geopolitical strife contracts online? I hope that all these are a sell.
I think they all are. I mean, anybody that watched what we did to Venezuela, and then with the threats that we had with Iran just a couple weeks ago, Oliver, we know where all the money went because it fled the country. We know where all the mullahs went and where Khomeini's group all went. I mean, that was the greatest head fake, much better than anything Barry Sanders or any other athlete could have done. Because, that head fake caused them to basically show us where everything was. And so now they know, number one, what we did in Venezuela, which is we came in the cover of darkness and basically took the leader. Number two, this is a situation in Iran where the superior force here, they're not superior in any way, not superior in numbers, superior in military. Choose to go down that, like Rubio and B. Vance have said, there's going to be a price to pay for that. And the price to pay will not be another Vietnam. It'll be a lot more like Venezuela. It'll be a surgical removal, and they'll be lucky if that removal is just taking a living person out of Iran. It might much more likely be taking dead people out of Iran and letting the Iranian people decide what they want next. I mean, we don't want to run that country by any stretch, but we also don't want them threatening the world and closing the Straits of Hormuz. So I think this is going to be one of those things where cooler heads will prevail. Again, they have seen what we can do. They don't want any of that. As Donald Trump would say, you don't want any of this, guys.
I'm pulling up, will the Iran close the Strait of Hormuz this year around Kalshi? I mean, right now it's almost a coin flip. So it certainly could be potentially something that surprises markets if it does, but we hope not. And I think for the most part, I want to fade the geopolitics. I got to say too, John, you texted me, I thought, with the great stock idea today, which echoes something my other guest, Chris Bretcher, pointed out, which was travel stocks. And that to me looks a lot more like everything's going to be all right than everything's going to get, crazy. Tell me what you're looking at.
Well, we're looking at a lot. I mean, for instance,
I got NCLH looking pretty good.
Yep, NCLH, Norwegian Cruise Line Holdings. These guys, of course, Americans in big numbers, and it's not just Americans, but have been going on to cruise lines, onto cruise ships. We're in basically that sweet spot where it's cold up north, but it's where I am in Puerto Rico, lit every day. And I think that Norwegian Cruise Lines is going to continue to see some very positive booking numbers and room sales and all the rest. So somebody stepped in today, Oliver, and bought 3,200 of the May 25 calls. That's out in May, I understand, but the stock was 24.69 when they did it. So they're basically buying the at-the-money call, betting that, well, I think it's going higher between now, February 18th, and May 15th. So I basically have April and then May, March, April, and May. I've got 3 months for this trade to be right, and I'm only risking basically 10% of what it would cost me to buy the stock. So
you said they're buying which strike, the 25s?
25s out in May with the stock at 24.69.
So almost at the money here, $250. It's running you $250 right now to buy that.
Yep.
Okay.
And,
so you get time for it to move. The chart kind of has this like coiled up thing going on if you zoom out on the long term. But to your point, people just have really loved the cruise stocks, surprisingly so. I was one of the things I was wrong about in COVID. I was like, this industry is toast. But, I was speaking too much from kind of perspective of someone who hasn't been on a cruise.
Well, and I am not a huge fan of those super big ships. So you and I would be the same there, even though you'd be in the poker room playing, of course. And
That's the other problem. That's the other
problem.
problem is they only got blackjack on those things, and the rake is insane if there's any poker. But then I also don't want to be the guy on the poker cruise, but I might one day. Because they've got those,
Yeah, you know what? They should get the gamble on the poker cruise.
That's right,
Because
100%.
You would rock that.
I love it. In fact, we should run it there. You betting on the Olympics at all, John? I don't know really jack about Winter Olympics, and I barely know enough about football to make a few bets this year.
Well, I've been rolling over winning bets on the USA hockey team.
Okay.
And
right.
and the USA women. I'm betting on both. So this is not John being a sexist. I'm betting on both.
You're betting on everybody. All right, I like that.
Yep. And in both cases, the big one standing in the way, I think, is Canada. And it's a blood match for both men and women fighting against, the place where hockey was invented. But as I heard some USA hockey players say on a meme this week or on a reel, they said, appreciate Canada because they invented hockey. We perfected it.
Right, nice. Look, pretty dramatic. It was a pretty dramatic moment here earlier in the day because I'm looking at the odds on Kalshi right now and how it developed, and the U.S. jumped up to 40%, and then we lost it, and then Canada zoomed back up. So, pretty nice to be within trading at a 3 handle right now against the folks who invented it.
Yep, is. And those are exciting matches. I know people love watching curling. I don't get it, but I know they love watching curling. I'm really more of a hockey fan and a downhill skiing fan. So I've loved what I've seen from the U.S. women's team. And
skiing was pretty wild.
Yep. And you can bet on all of that, whether it's Kalshi or whether it's Polymarket. Love them both for the fact that you can, basically run with the momentum and then trade out of it. You don't have to hold it till the bitter end.
Right.
There are modifications to bets you make in Vegas where you might be able to do something similar, but I think the real edge is being able to trade in and out of particular. And again, by period, you could do it by period. If all of a sudden the U.S. and Canada are 2-2, you could, basically define your bet for the end of the game. It's
Right.
the
Yeah.
bet. I
No,
love that.
100%. It's the market gets liquid enough at the best times. John, before I let you go here, the next couple of days we do have some economic data on the way. The numbers for durable goods surprised positively, even though the print there could have been better nominally. It was still above the consensus. You've also had industrial production, which hit above. All the manufacturing stuff continues to surprise right now. I don't know, John. I'm feeling more and more like I don't want to switch up this Fed, but I don't have a choice.
Well, you know what I'd like to switch up? I'd like to get Jay Powell the hell out of there.
I know you do.
This joker continues to say that he is data driven. Now, if you've looked at Trueflation lately, it's under 0.9%. Trueflation. And you look at, any measure of inflation, it isn't going up, it's going down. It's going from the upper left to the lower right.
That seems like job well done, right?
Yes, exactly. But if you're data driven, then why aren't you? Why are you afraid to cut rates?
Sure.
In other words, he moved up rates and kept them very high for way too long, just like he left them too low for too long. And now, instead of saying, "Yeah, I am data driven," and "Yeah, inflation's under control," and employment also had a positive reading for us last week with the January data. So what's your excuse now, Jay? Just because you hate the president, you don't want to move on rates? You're screwing the American consumer.
I mean, we look at the trend for the Fed funds rate. Obviously, he's cut since the high, but it's been slow. My counterpoint, as it's always been, John, is just if it's not broken, why try to fix it? We're okay. Maybe it's now we are in the clear. And I think they are going to start cutting rates, right? He's just not necessarily rushing to do it. We got stocks cruising at highs. We got economic figures printing pretty good. Luckily, bond yields came back in, so I don't think he's got to worry about it too much. But I think they want to, right? It's going to get there. It's just, if you rush it now, then it almost seems like he'd be doing what the Republicans said they didn't like to begin with, which was like doing something political.
Believe it or not, it's going to play right into his hands too, because you know what's going to be happening once we get the new Fed chair in there after, Powell is gone in May, we're going to get cuts going into the midterms. How do you think that's going to play? So this guy being a fool and being a liar by saying that he is data driven when he is not data driven is playing right into Trump's hands here.
All right, well, we'll see. I'm worried that when he does, we might get some havoc in bonds, but so far it's pretty chill. Thanks, John. I like to look at the cruise lines too. That's a nice trade on the American economy. Appreciate it, sir.
Appreciate it, sir. Have a good one.
You got it. Jon Najarian, Market Rebellion. Okay, we got a 2-minute break, innovator buffer break, and then we're coming back. We got Mr. Scott Bauer. We also got Mark Dow joining us in the second half of the show here. Back in a moment.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future Finance. We got Mr. Scotty Bauer on the line. Yesterday, Scott, we were talking silver and gold, and it kind of looks like they're trying to make another move. What do you think?
Yeah, they sure are. They're both off the highs a little bit today, but we talked about this, and yesterday was a perfect buy the dip scenario, which we talked about, that I believe we're still in that environment. Now, we did buy it yesterday. We got out today. So I'm not looking in this environment to hold, for a nice long swing trade. I think the volatility is there enough where you can look at these trades, not minute by minute, but maybe a day or two. And then, bulls and bears, go to, or bulls and bears prosper, pigs go to the slaughter. So I looked at this trade overnight, which, we made 70% on this option trade, and I'm out. And if gold pulls back again, I'll probably get back in. If silver pulls back, I'm not as likely, because I think that trend in silver is a little bit iffy compared to where it is in gold.
I agree. I feel like the chart reflects it. But with today's bounce, I wonder if I should be adding on for SLV, by the way. I should ask if you were looking at futures or ETFs, but
yeah, I'm looking GLD and SLV. Sorry about that.
No, all good. The 65 support now looks a little bit more reasonable, after today's bounce. Because yesterday we threatened that line, we held it. So we've kind of got this descending triangle in SLV, which generally airs bearish, but if it doesn't break down, it usually the suggestion, the idea, the way I learned about the triangles is that you can then go back to the top of the triangle.
No, there's no question about it. And if things start to heat up again geopolitically, or, let's see what happens with rates and the dollar here, there's no question. I think the upside is still there. But when we talk about a pure buy the dip on some sell-off, I think there's more success right now in GLD than there is in SLV.
Okay, I agree. The chart there looks better, right? It's kind of they look so similar if we go back and forth.
They do.
But then there's such a key difference, which is that GLD does not have that descending triangle. It actually has, arguably, an ascending triangle with resistance at 470 in GLD.
Absolutely. And again, the only reason I got out of my trade today from yesterday is because the profits overnight were just way too extreme. I didn't really expect that we would see GLD move 10, 11 bucks today. We got it. So I'm out, and I'll wait for the next setup.
Next setup, you think if we get above 470, start to get back in, then maybe you start thinking 510 bucks? Because it certainly does not look like a far cry compared to silver.
No, I don't think it's going to take a lot to get another push higher in both, but my conviction is definitely with GLD.
Okay. GLD with potential to spread its wings and fly again. Today, the stock market is holding in, but it kind of looks to me like if there's anything ready to fly, it could be semis, Scott.
Yeah, it's been a nutsy market, especially with semis, with chip stocks. And we talked yesterday a little bit how started to see some cherry picking coming in there, and it could be that time where there's a lot of room to the upside.
What do you think will kind of get us free of this range? Brent and I were talking about the calendar, maybe expiry winding down, a pretty big day for options on Friday.
Pretty big day for options Friday and also PCE. So if we get a print in, PCE print similar to what we got CPI last week, I think that gives a lot of impetus to see a next leg higher for a lot of those stocks.
Numbers today, pretty solid again. Industrial production hitting above expectations.
Absolutely. So, overall, the data is pretty good. Let's see if it can sustain itself. And I have to run here, unfortunately, into the close. Got a busy last 20 minutes here.
You got it, sir.
And I will see you tomorrow.
All right, you the man, Scotty Bauer. Appreciate it.
Thank you,
nice
sir.
Look at gold and silver holding in. Few good comments in the chat along that line as well. Be right back. Might answer a few of those, and then we got a long session with Mark Dow, going to give us his thoughts on Bitcoin, the Fed, and more in a moment.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance.
Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance. We got stocks trying to hang in right now. The S&P 500 with about a 40 basis point swing on the day. 68.72 is where we're at right now. Let's look at the chart. Had a few interesting comments in the chat, and I'm going to also get Mark Dow on the line as we speak. As we're going to talk some Fed, we're going to talk some Bitcoin, of course. Mark dials in. Mark, you on the phone? Can you hear me? We might have to get him on the other one. Okay, as we do that, here's the 2 things that I'm looking at. One is that you've got the chart that we talked about at the top of the show, perfectly symmetrical basically right now. To the upside, resistance at 7,000. To the downside, support at 6,800. Market basically kisses that intraday. Hey, there he is. I think I just heard Mark Dow.
Hey.
What's up, man?
Hey.
The mystery man, the mystery macro man himself. Long time no chat, Mr. Dow. How are you?
Good. How are you?
What's up, man? You driving around in California, sunny and beautiful?
Well, it's been raining a little bit, but right now the sun's out. It looks pretty good. The ocean has the white caps on it, so it's still kind of windy, probably waiting for another storm to blow in. But at least the Sierra Nevada are getting covered with snow for all of us skiers out here.
Yeah, unfortunately, some skiers got covered too. Terrible headline out of Tahoe, avalanche.
Yeah,
That's crazy.
backcountry is not a smart thing to be doing when it's storming like this.
Seriously. Mark, I appreciate you jumping on the show. It's been a while since we've spoken. For those who don't know
It
you,
has.
you run Behavioral Macro. You also have a public X. Behavioral Macro is the paid feed. I think you're one of the best macro minds. I have learned quite a bit from following you over the years, so I kind of thought we were overdue for a catch-up here. And for those that don't know, you're the Batman of markets. We don't see your face, but we hear your voice. Appreciate you being here, man.
I'm doing you all a favor, trust me. Yeah, thanks for having me.
Yeah. So, okay, look, I mean, I want to talk to you about Bitcoin first. To me, that's like top of the list, just because another day where Bitcoin not only has lost its positive beta to stocks, it's like it's now developing a negative beta. So tell me firstly the market action, because we're like trying to buy stuff here, and all the pumpers in chief are out. We got the Trump brothers, we got Saylor, but there's no bid in BTC. How bad is that?
Absolutely none. So it's an asymmetric beta. That's what's happening. I even measured it a week or so ago, and I mean, kind of the way you look at it is Bitcoin is naturally 3 times more volatile. I mean, depending on the periodicity you use for the calculation, but roughly 3 times as volatile as the S&P, or the NDX is what I did it against, right? The NASDAQ 100. And that means on a day where the NASDAQ is up 1%, Bitcoin should be up 3%. And when it's down 1%, Bitcoin should be down 3%. Well, the beta is working fine. It's strong on the downside, but on the upside, on average, it's up at best 1-to-1 with the NDX, and there are a lot of days where the correlation is negative. So we call that an asymmetric beta, and it's extremely unhealthy. Worse, if you look at the chart of the past 6 months or so, you can see there's just not even really a bounce. A couple times we went sideways for a while, but there's no bounce, and there are good reasons for it. I mean, I think this is meta macro, right? It's not really a macro thing. Everybody wants to ascribe it to something macro because they want to continue. Usually Bitcoin bulls that are looking for a reason to hope their way through this episode, but it's very different from the other episodes we had. You know, Bitcoin is known for having massive drawdowns and then working its way back. And often for for having an asymmetric beta to the NASDAQ in the other direction, right? And that's just not happening this time. And there are some pretty good reasons, idiosyncratic reasons why. One is that just from a narrative point of view, AI and quantum and stable coins have taken all the oxygen out of the room, right? It's just not exciting anymore. There are things that are shinier out in the universe. The second reason is that it just hasn't done it, right? We've had all these promises, hyper Bitcoinization, and the next promise, and the next promise, and they keep moving the goalpost, but it never, ever delivers a killer app that would force the average guy to adopt. Right. And that's usually how technology gets spread. You have old guys like me that say, do I really have to do this thing? Do I really have to buy a cell phone or whatever that technology is? And then you say, OK, yes, I do, because there's just too many things I need to use this thing for. They've never delivered anything like that for Bitcoin. And people are kind of giving up, and what we're hearing and seeing from the patterns is that it's the OGs that are selling, right? They're leaking. The guys that have been around for a long time, I think they're just saying, okay, it's over, and I need to take some chips off the table. It's been a great run.
Mark, the fact that you've got now the President of the United States, his children going on CNBC, I kind of made the joke earlier, here's a good TV trick. If there's ever 2 guys from the same company sitting down, it's usually a promotional thing. And it's not doing anything. And also, I have been talking about the chart pattern I've been watching for years that has amazingly held, even in an uptrending price market. It was downtrending momentum. The bearish divergence in Bitcoin, to me, that basically tells us a story of incrementally difficult marginal buyers to find. And maybe that makes sense that the president of the United States would be the top of this so-called pyramid.
Yeah, I think so. There are two other reasons that I didn't mention, right? I don't know even if they're secondary, but I just had them ranked a little bit like that. One is that with the Trump administration using crypto as a grift vehicle, basically, you had the maximum pump, right? You have
right. They sold coins, by the way. I won't use the word grift. That's fine, but they ultimately sold coins and assets when everybody was hoping they would be buyers, right?
Yeah, well, I'll use the term. It's obviously
sure,
grift.
yeah.
I mean, that's just it is what it is. And listen, Bitcoin. Another thing that I've never liked about the space is it's full of grifters. Not only is it built on fatuous and laughable understanding of how monetary policy works, it has this problem. So if everything is pointing its way, they've got everything lined up in its favor, and it's still not work. So on top of those other factors, it's still not working, right? So there's just the reason after reason why this particular decline is different, but it's going to continue to play out, and for me, it was inevitable that it would die. But listen, Beanie Babies and other crazy things can go much farther than you think is rational. And before they're done, I just think probably Bitcoin. I mean, you never know for sure, but probably Bitcoin is done this time, and it's moribund, right? It's just it's going to die. The macro backdrop is probably not super helpful in the moment, and that really is two factors. One, you have you have the draining, I guess, or the re-rating of the U.S., right? So everyone is kind of looking at the U.S. and saying, after last year, they're saying, well, the U.S. isn't as reliable a trading partner as we thought it would be. And then we got more chaos on the policy front, just announcements and then changes of mind and then rechanges of mind. And then people began to say, you know what? And they look like they want to politicize the Fed. So why would we, it's not really going to be a destination, as attractive a destination for capital as it once was. And the whole world has spent the last 15 years or so gorging on U.S. denominated assets, right? The world is massively overweight U.S. denominated assets, and Mag 7 in particular. So that's one thing in the backdrop that's just not working for us. The other thing is the AI uncertainty now, right? A lot of the last ramp we had for the last half of last year was AI centric, right? And chips and all the things that were going to fuel it. Now people are saying, is any industry safe? I want to be in the industries that are hermetically sealed in their protection from AI disruption. So valuations got high, so they're just kind of gravitating away from AI. So the AI uncertainty is kind of metastasizing through almost all the majority of stocks, and they're just kind of leaking. And then you have the fact that the U.S. is getting re-rated for policy uncertainty.
Mark, question on that.
To put it bluntly.
I got a question on that.
Yeah.
Because it seems like the re-rating that you're describing that's happening as a force of AI is notably not happening in the hardware space and in some of the more kind of old school manufacturing areas. Like my favorite trade has been long SMH, short whatever, because Bitcoin gets wrapped up in this conversation because it's essentially software, right? And if AI is forcing new hardware-driven productivity, then we're going to go through all the software areas and trim fat, of which there's probably a good bit, and I think the most in Bitcoin and most in crypto, basically.
Yeah. I think that's what's happening. Well, Bitcoin is kind of irrelevant in terms of productivity, but things that are software related, that's exactly what happened. But the re-rating is not happening.
If Bitcoin is the lowest productivity thing ever, and you now have AI, which is the highest, that's going to be bad for Bitcoin.
Exactly. So yeah, I think hardware over software, sure. But even when you have, listen, if the U.S. is, someone with a sharp pencil out there could be saying, well, if the U.S. is getting re-rated because of policy uncertainty, right? And then there's this AI thing also happening. Why is the dollar rallying today? And that's because it's where the positioning is. So when you have an environment where you're leaking risk, right? And we're not blowing up, and it's not dramatic for macro reasons I can talk about in a sec. But when this is happening, people say, okay, where am I overweight? And in addition to gorging on AI, people have been buying foreign stocks, and they've been loading up on foreign currencies. Look at a chart of the Mexican peso, right? It's a one-way street. The Mexican peso is basically the S&P. I mean, the Mexican peso is the SPY of emerging market currencies, right?
Okay.
So it's just been a one-way trade. So that's where the positioning is. That's what's happening right now. The re-rating of the U.S. for policy reasons and the AI uncertainty are leading to risk reduction, and it's hitting those spaces where people were out over their skis a little bit too far. Now, the reason why I don't expect things. I expect things to leak and not necessarily blow up is because the other element of the current administration's policy is max pump. They want a maximum pump, right? They're max pump fiscal. The deficit, despite the protestations and the assertions and the promises, the deficit is rising, right? Maybe not dramatically, but the deficit's certainly not shrinking, and it's from a very, very large base, right? So that's the first thing. The second is they want to politicize the Fed. It's very clear. They want lower rates.
I think a huge mistake, by the way. I think one of the biggest and most formal mistakes economically by President Trump is pushing Powell out when everything seems to have gone way better than people from both parties estimated at various points along the last 10 years, myself included at certain junctures where I did think he went transitory too long, or but things that I thought might happen did not. Things that you thought generally would happen did. And I think that Powell has been largely proven very much not only capable, but a very good steward of the economy.
Yeah, I got a lot of heat for defending these guys at certain points in time, and people, the allegations of being politicized and all stuff. I found it laughable because if anyone remembers, the market spent a year and a half begging Powell to cut rates, and he wouldn't do it, especially in the wake of the Silicon Valley Bank blow up, right? But at other points in time as well, I think they've done a really good job. And on the transitory, it turned out that it wasn't transitory as Austin Goolsbee likes to say. It was transitory, right? It was just a longer period. Right. And if you think about it, they did exactly what they were supposed to do. You wait as long as you possibly can. You try and look through it.
That's what I was just saying. I was just arguing to John. If the market is not forcing you to make a big change, why not let it simmer if you've got stocks at high, if you've got stable employment?
Exactly. But this, back when everyone was saying the Fed should have hiked, right? Hiked earlier. The Fed was saying, listen, we're going to wait until we see a risk that inflation expectations start to get unmoored, and then we will go hard. And that's what they did. And listen, if they had started raising rates 3 months earlier, what would it have changed? Look at the inflation path around the world. It was the same in virtually every single country. So how much inflation would we have been? It wasn't going to change the shipping container stuck off the, I could see out the window lined up from Long Beach all the way down to Oceanside, right? That wasn't going to change. So I think they did an excellent job, and it's really damaging to the Fed's reputation, not just because Trump has done this, but because even when Trump is gone, whenever that may be, people now know that the U.S. is capable of doing this, because for the past 30 years, people say, okay, but we know you can't touch the Fed, and the Fed is the cornerstone of global finance.
Well,
so
at least it's just at his term. At least it didn't get nastier than it is. At least he's seeing out the term, I guess. If I want to spend that possibly as it could have been.
Well,
worse,
listen, it makes it less bad. But the thing is, now that's kind of it's open season. We can't go back. Just like with our international allies, they're going to say, okay, everyone says, well, once Trump is gone, our relationships go back to normal. It's just not how it works. If you have a boyfriend that cheats on you, you're never going to be able to fully trust him again, right? Yeah. Right. And even if you get over it and you get back together or whatever, you can't really forget it. And I think that's where a lot of this is. But I don't think that the Trump administration is going to be able to do that much on the policy front, the Fed. But we know that their intention is max pump. And
Mark, is that going to blow out bonds? Because I know you got a hard out here in 4 minutes. I want to make sure.
I don't think it will blow out
bonds right now.
I don't think it. No, and I think that's
if they're going to cut and we don't need to. That sounds like yields up to me, man.
It's a widowmaker. I don't think they're going to cut. I don't think they're going to cut. They're not going to be able to, because they will not have politicized the Fed enough in time to be able to do that. We're probably going to have. we're probably, I mean, over time, if they're long enough, they can replace the people and insert people like Steve Marin who are entirely politically driven, and they might be able to do something. But that's going to take a while. It will be interesting if Powell impedes that process of politicization by sticking around longer. I don't know what he will do, but he might do that. But nonetheless, if the situation is max pump, if that's the policy stance, it's really hard for the economy to fall apart. Right.
Yeah.
The super interesting scenario will be if inflation comes back, and if you read the minutes from the Fed now, some people say we should be a little bit more two-sided to our approach to things. If that comes back and they don't hike, right, then it might get interesting. But anyway, that remains to be seen. The overall scenario is bleeding risk for the reasons I mentioned, and Bitcoin looks like it's in a death spiral.
I generally am on that board too, and even though I've been a crypto cynic for a long time, I've made it clear that the technical study that I've been following, I will be religious to. I will be a zealot for the bearish divergence, because to me, we've never really seen a pure kind of MLM style thing charted before, and to me, making new highs in price but increasing difficulty finding the marginal buyer would be the perfect kind of surreptitious way for this thing to finally peak out. Does that mean, but here's the thing, Mark, that I see a lot of people get wrong, is that a lot of people come out and they go, oh, Bitcoin's a zero, Bitcoin's a zero. Will there not always be some person willing to pay non-zero? Because to me, MicroStrategy is the zero, not Bitcoin.
That's probably true. I don't know, that's too hard to know how it all plays out or how long it takes. It just seems like it's over. They've looked behind the curtain and they realize that it's not what everyone thought it was going to be. That's really it. But assets that are emotional and don't have fundamentals are the best ones for technical analysis. They work best. Gold, silver, particularly when they go parabolic and get crazy. The less fundamental support an asset has, the better it is for charting, because it's driven totally by vibes and momentum.
It's like a boat with an anchor. The further you are from anchored in any kind of profit or revenue stream, the more that boat is going to swing around, right? And so the less something is anchored, the more it's going to be wild. And Bitcoin is the purest one.
It definitely is.
Mark, you the man. I know you got a heart out here at the Bell. Appreciate you jumping on. We will be in touch again soon.
Thanks. I appreciate it, Oliver. Take care.
Perfect timing of the Bell there from Mark Dow at Behavioral Macro. Great stuff. Appreciate Mark for jumping on the show, joining us from California. That's the Bell. You heard it ring. And the market ended with a good bit of green on there. Thanks for tuning in to Chicago Future of Finance. That's it for the day. I'm back tomorrow, 2 p.m. And by the way, another tease for next week, the Money Show in Las Vegas. Catch me there. Have a great night.